Got a little bit here. So, welcome to season 2, episode 4 of our podcast. So, today we will be speaking about large savings and investments in relation to considerations for inheritance tax.
It's a mouthful today, isn't it?
Yeah. So just to recap on our previous week, since this is the episode 4.
Yeah.
So in week 1, we spoke about the challenges with property, estate planning, and inheritance tax. Then we spoke about expecting an inheritance, inheritance tax considerations for business owners, and expecting an inheritance and things to consider. So just to recap, that's what we've gone through. Please do check out other videos as well, because if you're watching this, it might be helpful for you to also watch the previous videos.
Yeah, and we're big on education, so the more you know, the better.
Yes. So let's just jump right in. So large sums of savings, why is that an inheritance tax problem?
That's a really good question. I think large sums of savings or cash, whatever it might be, definitely adds up to someone's estates. And just to recap, inheritance tax is really a charge in the event of a death taking place where there's a transfer of value that's taken place as well. So if a large sum of cash is involved and that's transferred to loved ones and family members, then that will trigger a tax. Now, the threshold, just for memory purposes and for those who don't remember, it's if you're an individual and you don't own a property and you don't have any children as well, then it's £325,000. If you are an owner of a property, occupy it, or have occupied it, and you have a child or children, then that can go up to £500,000. And if you're a married couple, then you can double that to £1 million. Also, to consider if you're a widow, then potentially up to £1 million as well, or widower. So if your wealth exceeds that and cash is involved, then what are we going to do about it? How do you plan to mitigate inheritance tax? If that is your concern, obviously not everyone is concerned about that, but if it is your concern and you don't want to pass 40% to HMRC because of transfer of wealth from you to loved ones, and we're all about protecting generational wealth and building generational wealth, then what do you want to do about it? So large sums of cash can be a challenge, and it's to discuss those. What are the potential options you have as a general guide, and why you should be considering it.
Okay, so, yeah. Thank you. So for those with a large estate value, we know this is called the residential nil rate band. Why is it so complicated, especially if theirs is over 2.5 million?
Yeah, so the residential nil rate band, unfortunately, is not a default allowance. So when I say default, the nil rate band, the 325,000 I mentioned, that comes as standard once you're over the age of 18. That's applied. But with the residence nil rate band, which came out in 2017, it needs to be claimed, and it has to be claimed within the first 2 years of the death event taking place. So it's really important that the executors take action quickly. There's no deadline. There's no trigger point for when probate must be granted. So 5 years could go down the line, and family members are like, oh, we better sort something out, and they've lost out on up to £350,000 because of poor planning. So what is important, looking at a live show and I'm getting a phone call, naughty Richard, sorry. So what's important is monitoring that, and there's now a tapering as well. So if your wealth exceeds 2.5 million, which is not hard to do, especially if you've got a lot of cash savings, then for every pound that you go over that 2 million, basically we deduct £2 off of the allowance. So once you hit 2.35 million, you've lost your £175,000 allowance, or a couple £350,000 allowance, and you've only got this £325,000 each. So we've now got more money attracting inheritance tax, and that's not a good thing. It's more money that you're going to be you're forking out. So we've got to look at these things sooner rather than later. And even if you're aware of it, then you can plan for it. If you're happy for it, then that's not an issue. But ultimately, most people are not even aware of these things, and it's wealth can accumulate in a lot of ways. So it's important to just keep an eye on it.
Thank you. So, since that's such a big issue, I would say, what is the best way to kind of go around that in order to reduce the potential inheritance tax?
Well, there's lots of options. I mean, with cash, it kind of does venture now into the IFA, the independent financial advisor route. Typically, with financial advisors, unless they are, they delve in the realm or have a knowledge or modicum of understanding of estate planning, their focus is purely on, and this is not a knock or a dig, it's just how it is growth of funds. Now, that's a good thing, but when your clients are hitting 70, 80 years old, they don't need that. They need to think about transferring that wealth. And yeah, I'll leave that there. I don't want to start knocking the IFAs to do a wonderful job. But ultimately, the job I find I'm tasked with is educating the IFA to look, come on, they're rich enough now. Let's change strategy of how you're going to pass the wealth down or transfer it, because they've got an issue with inheritance tax, which is never normally discussed or raised. Or if it is raised with the IFA, the client's like, no, leave it alone. And then they forget about it. And now they're later in years. And so you're leaving the gateway of time to a very narrow perspective. And there's not much you can do in terms of making gifts. So the options are very tight. So the first and easiest one is to spend the money, if that's something that's a feasible option. If that's not, because you need the income to survive, and it depends on the volume of income we're talking about, then there's different options to consider, and that's hence time needs to be on your side. So, and the products that I would normally start talking about, not to get too techie, but maybe you can raise a question with your IFA if you know this applies to you. Something like loan trusts, discounted gift trusts, reversionary trusts or flexible reversionary trusts, to name a few things where we can start to look at, especially if income is a consideration. You can be flexible about how much income you want to keep, having a choice to keep it or keep in the trust, and then that will start to reduce your estate. You can look to make a gift into a trust and maybe take a hit on the inheritance tax during your lifetime. So maybe pay 20% now, survive 7 years, rather than to take 40% later. 20% is far easier and cheaper than 40%. It's less than the capital gains tax. I don't know what the shifts in capital gains tax is going to be, so it's a bit of an interesting topic at the moment. But as of today, time of recording, and this live show, literally we got to be very careful of how we do things. So those are the discussions that we have with clients, and look at their overall assets and their plans. Do they have children? Do they not have children? What's the bigger picture looking like? So all these are the questions that we'd have to ask so that the planning can be done. It's not a simple 1 hour consultation. Not normally these are long conversations, because everyone's different. Everyone has a different viewpoint, goals, passions, and they want to just sort of support causes that they believe in, essentially. So that's the long and short of it, really, in terms of how we would guide or gauge our clients. Age, obviously, consideration is a big deal.
Okay, well, thank you. That was really, really insightful. Also, just to go into the second half of our topic for today, what about large investments?
Yeah, it's a similar thing. Again, it depends on the type of investment. The only thing that we can do, because we're not regulated financial advisors, is to work with the IFAs to say, look, what are you going to do about this? What is an efficient structure for the client at the moment? If they are concerned about minimizing or mitigating the inheritance tax, and is there any kind of tie-ins? Are they going to get charged for coming out of a particular investment? What's the client's age? What do they want to achieve? We're not talking about pensions, just for the record. So like actually cash investment, stock, shares, etc. And what can be done? And so when we work with the IFAs, maybe they want to understand how the will's been drafted. understand the dynamics and what can be what we've discussed with the client from a planning perspective. And then really age, I keep bringing up age, but it is a big deal because the older you get, that 7 year survival is a crucial thing, because you don't know, no one has a crystal ball. And it does limit how flexible we can be in the planning for the client. There are like some schemes on the stock market that can attract business relief. So it's 2 years rather than 7 years, but they could be potentially, I wouldn't say risky. I'm not an IFA. Some IFAs saying that there's some really good products out there. There's lots of solutions out there. So, you know, it's important that people know who to speak to with really good bespoke solutions. And we're happy to put people in touch with IFAs that we work with that can help them if they think that's a discussion they need to have. Okay. Definitely.
Yeah, definitely agree as well with that. Well, thank you so much, Richard. That's really insightful.
Oh, wow. Yeah, I mean, it's not a topic that you can talk hours on.
Yeah.
It's a regulated product. When I say product, investments are regulated. Cash is only so much we can talk about because it's an area where, as I said, either you spend it and enjoy it, or if you're going to make gifts. The only thing I'd say about gifting large sums of cash is the recipients have that problem. So you're just transferring it from you to them.
Yeah.
Is that the wise thing to do? What's your viewpoints on inheritance tax gifting? Maybe skip a generation, give it to grandchildren, because there's also income tax benefit to that potentially. So, and the other side of cash, which I didn't really raise, which could potentially be an issue, is if you have a business with large sums of cash, something to also keep an eye on, because business relief could be lost if cash is in there for too long.
Yeah.
And if a large sum of cash is in there. So if you know, it's called cash flow for a reason. If it's not moving, it's not being used, it can sort of cause a problem. So yeah, those are the kind of the recap points. So if that is you and you fit into that particular situation, then definitely reach out to your advisor, reach out to us if you want any further discussion on it. But yeah, that's really the long and short of it for this week.
Thank you. Thank you. And if you know you have any questions, please don't hesitate to ask us. We're always willing to answer, as long as they're not specific advice questions.
Exactly, yeah.
We're always willing to just answer and cover what we've discussed in our podcast. And I really do hope this is useful to you, because we only do it for you.
Yeah, and thank you for your support.
Yeah.
You know, we really do appreciate the feedback we're getting and the support and the viewers. So much appreciated. It means a lot to us.
We really do see it. So
yeah.
Anyways, thank you. And please let us know what other topics you'd like us to discuss.
Absolutely.
And yeah, thank you so much.
Cheers.
Bye-bye.
Bye-bye.